Good morning, everyone. Hi, it's Jeff Fitzpatrick. This is my weekly update on US stocks and options. Today is Monday, the 10th of June, 2024. And this week, I've got some big changes to the dashboard, some really good improvements, I think, but I can't call it complete because I'm sure I'll keep finding new things. Only yesterday, I had a discussion with a group of guys that do some really good background research for me, and they came up with a whole new idea as well. So it will be an evolving dashboard reflecting my time in manufacturing, which is an area of continuous improvement. So let's get going. So TICN, first of all, although it's still 141% up on where it stood on the 31st of March 2020, last week it fell by nearly 3%. The S&P was down by just by 0.38%. The Nasdaq was up, must be the tech stocks doing well, and the Dow Jones basically break even, or if you want to call it that, 0.5% up. But overall, the TICN stocks continue to fare much better than the other indices. There is some news this week. So Hanes HBI, they're selling its sportswear brand Champion to Authentic Brands, and the shares rallied 15% on pre-market trading earlier in the week for that. Dollar Tree, DLTR, they're working with financial advisor JP Morgan to look at strategic review options. So we'll see what the outcome of that is. Paramount, they're in the news every week, and they've been outlining a plan in case the company's sale falls through, which includes cuts, but mainly job cuts and $500 million worth of savings. Intel, their Lunar Lake chip, that's set to be launched in the autumn this year, and it integrates memory directly into the chip, eliminating the need for memory sticks. So that's going to be a useful thing. Hopefully it gives Intel a boost. WBD have seen a price hike also because they've been raising the cost of their subscription services. Some major institutional news this week. Wednesday, 7 p.m. UK, the Fed will announce its latest decision on interest rates, and it will give its economic forecasts and make a statement. So we'll then get an idea, one, whether the rates are changing imminently, but more probable when they're likely to change. And we're expecting the interest rates reductions to be put back. So let's see what happens. Okay, so off to the shortlist generation. Quick reminder. First of all, I update my long list, taking the stocks down from 7,000 to 150. To get in there, you need a timeliness score of 1, 2, or 3, a safety score of 1, 2, or 3, a financial standing of at least B+, and to be really between $100 down to $5. Then I use the charts and indicators to reduce that list, taking around 100 of them out. Then the value line analysis comes in, and we get down to 5 or 10, and then we get the trading platform, see what's going on in terms of premiums and stock buying power, costs, etc. And that gets us down to 3 or 4 stocks for the short watch list. In fact, this week, we only added 2 new stocks. We'll see those shortly. Now, this is new. So what I've got here is a list of the stocks that have newly passed the test on the timeliness and safety scores, etc., and have therefore gone into the long list. And then I've got a list of stocks that have newly fallen out of favor. So, for example, their financial standing might have gone below B+, or they're scoring now a 4 for timeliness or safety. Of the ones that came in, only CTSH and GEN got as far as the next stage when I looked at the charts. So let's take a look at the dashboard and see how things are going there. And here we have it. So you're looking at the dashboard in respect of HURN. I believe that they are into consultancy, particularly into HR. But of course, I have a drop-down menu which can take us to any of the other stocks that are currently or have been recently put onto the shortlist. but we'll stick with HURN for the moment and see what's happening there. So across the top, we've got the name of the company, we've got the industry, we've got the latest date of a value line report, so we can see how recent it is, and we've got the timeliness and safety scores, the price to earnings ratio as calculated using the last 4 reported quarters of results, and I've got the book multiple. So if I buy a share in this, each share is like buying a business and having to pay 3.22 times the profit to get hold of it. Got the current price, when earnings next year to be announced, how many losses they've had in the last 3 years by quarter, last year's dividends, they're not paying them, and this is new, the total return on the capital over the last 5 years, 92.9%. That's actually well ahead of the overall picture as given by Stockton Value Line follow. Below this, we've got some of the current positions. So where the stock stands in relation to its 52-week high and 52-week low. Now, HURN is getting towards the top of its 52-week high. It's only got 14% of the way to go. And if we look at the chart, we can see why that is. The stock, since we identified it, 1, 2, 3, 4, 5, 6, about 7 or 8 working days away, it has shot up. So it's gone up towards the top of its 52-week high. In addition, we can also see this is the space left to get to its 18-month forecast. So it's still got 20% of the way to go there. Now also, as the stock price rises, it obviously gets further away from its the 52-week low. In this case, we're now more than halfway between the 52-week low and the 52-week high. That's getting a bit lofty. That gives us a risk to reward ratio, which is not attractive. Then we've got the debt versus capitalization. That's below 50%. That's okay. And then we want to see at least 100% more asset cover over liabilities. That's doing okay too. And then we've got the beta, 0.6. That's just about to become really important, and I'll explain why in a moment. Also new here, I've looked at the mid forecast, in this case 111.14, and said, well, okay, sorry, that's not quite, that's a different forecast. Let me just get the correct one. Yeah, basically 117. So of the increase, 70% is down to just the stock market increasing in its value over the next 18 months. So if the stock market was to increase by 10%, then we could expect this one to increase by 6% because of its beta. In many cases, I'm seeing that the amount required to be increased by performance to get to the new forecast is a much greater proportion than that. So I'm actually happy to see that that's not too high. But let me just move to those forecasts now. So I've got a couple here. So we've got the normal value line 18-month mid forecast. There they are. And something that I'm finding is that knowing the earnings predictability, in this case a score of 75, is beginning to explain why some stocks have a much wider range between the high and the low forecast compared to the middle. If that was 100%, we'd expect this gap to be very narrow. That said, I'm putting at least a 10% in as a margin of safety. But I've got 2 new forecasts in here. First of all, I've just taken a very, very conservative one. I'm calling this document the stock pilot. Pilot in the sense of at sea, nautical, rather than flying, because it's guiding us along. And I'm saying, first of all, take the mid, and the mid is where we are now, plus the increase we can expect from the general market rise, and that is that basically. Then, if the stock has a timeliness score of 1, I will add 10%. If it's 2, I'll add 5%. And if it's 3, that's average, I'll add nothing. If the score was 4, I would take 5% off. And if the score was 5, I would take 10% off of the increase. There might be a little error there. I need to look at that. This is still getting adjusted. What I've also done is looked at the price to earnings ratio, and I've looked at the forecast earnings that are coming over the next 2 years, taken an average of them, and said, okay, given the price to earnings ratio of this company, if the earnings are as forecast, I can back engineer it and find out, well, what would the price be? And that's what this one is. Also, below all of that, I'm putting in where we're at now in terms of price at entry to the shortlist. So, and these various original forecasts of when we got into them, so that we can look back in time and say, well, how are things working? Finally, I've got the 2 charts. One is how the stock is moving compared to the S&P. This one, HURN, is actually fairly good. It's had some widening from it, then it's moved back together, and it's reasonably well tracking it now. Then we've got the value line forecast versus the actual. So the orange line is just the quarterly average of the stock price. And we started that looking at that 18 months early. So 18 months on, the forecast had been for the price to be at this level. And remarkably, in this case, it was exactly where the middle forecast said it should be. Since then, of course, it hasn't quite kept up with it, but we can see at least that the forecast on the 18-month part of the world is reasonable at present on this stock. That's where we are. It's constantly evolving. I'm constantly also finding bugs and sorting them out, but it's going well. And the upshot of all that. So you're looking here at a chart which is based on Friday's closing prices. And we've got the stocks that the system has picked up so far. Some of them we may now not want to do. And I've gone right through and looked at all the charts and say, well, okay, what month am I interested in? How many days that's as of today to expiry? What strike price? What premium that's paying? How much stock buying power it's estimated to use? Then the return on capital employed. And then, for me, the all-important annualized capital return. And some of them are very good, and others are not so good at all. But we've got 4, at least at the top there: AKAM, PRGO, GEN, and BMY that are over 100%. The last column is showing the number of contracts that have been sold in respect of these, what's being traded. So really, the rule of thumb is I want sort of 300. Only one of the top 4 is at that level. Another one is not far away from it, and 2 are well short. So that's all right. It depends what I'm using the stock for. If in the case of GEN, it's very short term, very close to the current price, quite a low premium, just to make a quick buck, if you like, the 15.4% return on capital employed gets up there because we're only going to take a very small number of months. So we'll see how that continues on. For the moment, let's have a look at the charts on each of these and see how things stand. Okay, so we're looking at the daily charts. So ACAM, it had done the reverse J and turned around a bit, but it's changed its mind. So I'm not too worried. It will give another opportunity to get in. AKAM, it changed its mind. It did a reverse J, went back down a bit, but not very far, and just really following the market. I'm not concerned about that at all. We've got a good forecast in there, and we've also got a nice gap to be closed. So looking okay. BMY, that's fine. It got its reverse J and it's finding its feet. It's heading in the right direction. Indicators are fine. CMCSA, again, did a reverse J. It's messing about a bit, but it's okay. There's plenty of scope for that to continue up. Whether we'll enter it's another question. Could be a good time to dilute, though. CTSH is enjoying its reverse J and the indicators are looking fine. So if we got into that on the first uptick, we'd be laughing now. CVS, again, very good. We've identified that. It's nicely filling in the gap. The indicators were perfect when we went in, but are obviously moving up a bit. So we'll be following that. DOX, not quite ready yet. That's new to the table. Gen, now Gen, not looking too good. The 18-month forecast is below the actual price, but I think it has actually got quite a lot of scope to increase yet, but I won't be rushing into that one. And then HURM, which we've already seen. MGPI, again, we're looking ready. We're on the starting blocks for this one, waiting for it to turn. Pink, again, it's just turning just nicely. Prego has done the turn, indicators looking good. And the last one is TAP, which is Molson the Brewers. Again, it did its reverse J, it's messing about a bit. I'm sure that as the market finds its feet, that won't be a problem. And that's about it. So if you're watching this and you're not a member of one of our clubs, and you like what you see, get in touch. I'm more than happy to speak to you on a one-to-one basis, take you through how the clubs work, and the investment you can make could be as low as £100 a month. But we have got people that put in 100,000, and even people that trade with us and put in millions. But there's no rush on all of that. And next week, I'm going to be looking further into the research, see what comes out of that. We'll see some other new ones. I'm working at the moment on an assessment of the management capabilities. To me, the management of a company is all important. If I'm going to buy a company, I want to know that the management team are very good. Just to remind you, we've got live training at the Sofitel London later this month, Friday the 21st, just on the evening, 5 p.m. to 9 p.m., Saturday all day, Sunday all day. So Friday is live trading, Saturday is the scoring system, and Sunday is trading options, plus an awful lot of stuff which is brand new to the club members. If you want to attend, have a look at it, go to myinvestmentclub.co.uk and you'll find a link on the front page there to get more information and to tell you how to book. Hope to see you there. Just a final reminder, as every week, if you haven't listened to or read my book, it is available on Audible and Amazon and throughout the planet. You might find it interesting, useful. I'm told it's a very easy read. So if you don't mind, have a look.